We are almost 2 months into the new year and the bull market continues to be very resilient. So the S&P 500, it's up 7.2% year to date, and so far it has not had any major pullback or correction. There have been 3 small pullbacks. We had one pullback over there, another one over there, and recently another one over there, another one over there, and they were all less than a 2% pullback. And the market continues to be above the 20 exponential moving average. So as long as it's above this 20 EMA, you can see that this trend continues to be very, very strong. So that's the S&P 500. And let's take a look at the NASDAQ. How's the NASDAQ doing? NASDAQ 100. And that is up not too much more, 8% year to date, slightly more than the S&P 500. And again, year to date, it's only had very minor pullbacks along the way, right? So we have one pullback over there, one over there, and a slightly bigger pullback in the last couple of weeks. And how big was this pullback? Let's see, from the top all the way to the bottom. Oh, that's just about a less than a 4% pullback. Now, individual stocks, especially AI related stocks, continue to do really well, and justified because they're announcing blowout earnings. Especially NVDA just announced insane earnings. So the stock price going up is well justified. And in fact, I just updated my intrinsic value of NVIDIA to now, if I'm not wrong, it's about $690 thereabouts, the new intrinsic value. So it is still overvalued, but only slightly overvalued, not crazy overvalued. So the share price gains is justified by very, very strong earnings. So looking at individual companies, let's take a look. These are the stocks that make up the NASDAQ 100. And you can see, again, the high quality AI stocks are the ones that is really delivering. So NVIDIA up 59% year to date. Amazon, okay, up 15% year to date. Not too bad. Meta, up 38% year to date. Broadcom up 19% year to date. ASML up 30% year to date. AMD up 26% year to date. So these are the main guys driving the AI plays. And Microsoft up 10%. Underperforming is still Google. And Google's a great company, so I think Google is temporarily unloved right now because of some recent missteps. And I think it's one of the cheapest AI-related plays that are high quality right now. Now, Adobe also underperforming, but only recently the share price dropped a lot. Nothing wrong with the company, nothing wrong with the financials. It was just an emotional reaction because OpenAI just released a new text-to-video product that kind of like freak people out. Oh my God, are they going to affect Adobe's business? I don't think so. In the long run, maybe if Adobe can't continue to innovate and catch up, but in the short term, I don't think Adobe is going to be very much affected. So Adobe underperforming, but it's still overpriced. Adobe is slightly overvalued because it went up so much above valuation that even if this drop, Adobe is still not cheap. But I think Google is cheap. And Amazon is still cheap, although based on the charts, it's a bit overextended. I'll wait for a pullback to add more Amazon shares. NVIDIA, slightly overvalued as well. I'll love to add when I see a pullback. Microsoft, slightly overvalued as well. Meta, if I'm not wrong, Meta is slightly overpriced as well. So what's interesting is that even though these stocks have gone up so much, these high quality AI plays, in fact, over the last 1 year, let's look at the 1 year performance. Is this 1 year? Yeah, this is 1 year, right? Meta up 184%, NVIDIA 279%, Amazon up 83%, Google up 57%, Microsoft up 62%. So despite these great gains, they are not really that expensive if you factor in the earnings that they are delivering. Now, in my last few videos, I did mention that I expect a bigger pullback or correction to happen sometime soon in the late February to March period of at least 5 to 10% pullback or correction. But it has not happened yet. Reason? There's no catalyst. We need a catalyst for the market to have a reason to sell off. There was a catalyst, but the catalyst recently was that the economy has been doing better than expected. Job numbers better than expected, and of course inflation coming in slightly stronger than expected. So that caused a bit of a sell-off in the markets, but it was nothing much. It was less than a 2% sell-off. And I'm pretty surprised actually because as you guys recall, in the last year or so, the market used to be very affected by the 10-year treasury yield, right? So every time there's a fear of inflation, every time there's hotter than expected economic growth or employment numbers, the 10-year yield, every time the 10-year yield goes up, the market will drop a lot. The 10-year yield goes up, the market will drop a lot. But this time, the 10-year yield going up back above its 200-day moving average, the market doesn't really go down. Market just went down a bit and went up again. So what's the reason here? So I think one of the reasons is because the market has begun to realize that with the 10-year yield going up again with high interest rates, yes, it will affect your REITs. It will affect your bond prices. It will affect smaller companies that need lower interest rates to raise capital, that need lower interest rates because they've got more debt on their balance sheets. But the markets come to realize that if you're looking at the high quality large cap companies, especially those related to AI, NVDA, Microsoft, and Google, and so on and so forth, they are immune to higher interest rates. So it doesn't really matter that even if interest rates go up again, these companies will continue to do well. Why? Because number one, they've got very little debt. So they don't have much interest to pay on the debt, number one. Number two, they don't need to raise capital. And number three, they have got so much cash on the balance sheet that their cash is earning them more interest income that's adding to their bottom line. So the bottom line is that right now, the market seems to be immune to these high interest rates. But of course, if it gets back too high, then yeah, we may get more of an effect. The other thing is that the Fed now, everyone was expecting last year that the Fed would cut rates 7 times. They'll start cutting rates in March. And then the bear said that if they don't cut rates in March, then the market's going to crash, right? Didn't happen. In fact, right now, the market no longer expects the Fed to cut rates anymore until June. Take a look at this Fed Watch tool. You can see that for the next FOMC meeting coming up on the 20th of March, the probability of a cut or an ease is only 2.5% chance. So there's a 97% probability that the market is expecting no cut, stay, right? And the only probability where we see a cut is in the June meeting, where the market is factoring in a 62% chance of a cut, 37% chance of them holding rates. So again, the market doesn't seem to give a shit anymore. The market is like, okay, don't cut, I don't care, I'm still going up. So it doesn't really matter anymore, which is pretty interesting because the last 2 years it mattered so much, but the market doesn't care about this anymore. So why? Why is the market so resilient? Why doesn't the market care about the Fed not cutting rates or that long rates are going up? Well, there are 2 reasons, right? Number one reason is because a lot of people, a lot of fund managers, especially professional investors and even retail investors, they miss this bull market. So this is one of the most hated bull markets in recent history. And many bears out there are very angry, right? Because they've got all this cash sitting on the sidelines and the market is going up without them. So every time the market goes down a bit, the bears go, the previous bears. Now they start to put their money into the market and the market goes up again. So they keep buying it up, right? Because they missed out, they need to get back in. And currently we have got over 6 trillion in cash on the sidelines, parked in money market funds. And this cash is looking to come back into the equity market, especially once the Fed cuts rates in June and they find that they can't get as much interest rates on their money market accounts, they start to rush back into the stock market. And that's when the market will really, I think, really have an even bigger gain in the second half of this year. Again, that's just my guess. I could be wrong, of course, but that's just my guess. Now, the second reason why the market is so resilient is because the market is now beginning to realize something I talked about last June, which is we are in a revolution. We're in a new technological 6-wave revolution driven by AI. And if you think that AI is a hype, I'm sorry, you're going to be left behind. Not just in terms as an investor, you're going to be left behind in terms of your career and your business, because this thing is going to transform the entire economy. It's going to transform businesses. It's going to transform all our lives. And for those of you who have started using AI in your jobs, you can see the difference it makes. So if you recall, last June I had my mid-year event. Was it June or maybe July, August, right? I can't remember. Anyway, it was my event last year, the 6-wave event, if you guys recall. And I showed you this chart. I said that, every few decades, there's a wave of innovation that transforms our lives, transforms the stock market. And in the last 250 years, we had 6 of these innovation waves. So we had the first wave, the second wave, the third wave, the fourth wave, the fifth wave, and now we're in the 6th wave. The 6th wave is driven by AI. Now, how powerful is this AI? Deep Water Asset Management, one of these guys, I think Gene Master, one of the top traders, right? He mentioned something which I agree with. He said that if you take it out of 100, AI is 99 out of 100. The way it's going to impact everything. Now, compare that to the invention of electricity. The invention of electricity changed our lives. That's 100 over 100. But AI is close. AI will be 99 out of 100. If you look at the internet revolution that sparked the 5th wave, the 5th wave was the internet revolution. That was only 50 out of 100. The mobile revolution, when we started to go on our mobile phones, that was only 25 out of 100. So if you think that mobile phones change our life, if you think that the internet changed our life, my God, AI is going to change our life more than double or triple what we saw in the internet and mobile. So in fact, Sundar Pichai, who's the CEO of Alphabet, he said that AI will eventually have a bigger impact than fire, electricity, and the entire internet. So AI is not just another hype. It is changing our lives right now and will continue to change our lives drastically. Our businesses, our economy, our stock markets. Now, how do you know the difference between a stock that's hyped up and a stock that's really undergoing a fundamental change? Very simple. Look at the earnings. If you see that the earnings are growing as much or even more than the share price, then you know that the share price increase is sustainable, at least for now, as long as the growth continues. But if the stock price goes up and there's no real earnings, it's all like a pie in the sky, then that's hype. Now, I lived through the dot-com bubble, although I was younger at the time. I was in my 20s, so I remember the dot-com bubble, which people like to compare today's market with, was totally different. Because in the dot-com bubble, most of the dot-com stocks were unprofitable. They weren't making any money. So the share price was not backed up by earnings or cash flow. But in today's case, the companies that are driving up the market, like again your NVDA and your Amazon and your Meta and your Adobe and your Salesforce, your ServiceNow, they are actually making money. And not only are they making money, the earnings are growing at huge double-digit growth. So in my opinion, it is sustainable. All right. But of course, there will come a time when the growth will slow down. And of course, markets will go through corrections as well. Of course, that will happen. It doesn't go up in one straight line. But by and large, we are in this new 6th wave of innovation that only started, mind you, in 2020. So we're only in the 4th year of this AI and automation revolution that will last at least the next 10, 15, 20 years. So we're just at the beginning. That's what I'm saying. What kind of returns can we expect as an investor? Well, no one can see the future, but if you look at the past, you get a bit of idea. So in the 5th wave that was driven by the internet, by mobile, and by software, you can see that the S&P 500 gained 1,950% over that 30-year wave. So if you annualize it, that was a 10.26% annualized return. And I believe that this 6th wave that we're in for the next 10, 15, 20 years is going to be even bigger than the 5th wave. So I think there's a very strong possibility we're going to get an even higher return than 10.26% annual return on the S&P 500 on average. Now again, if you buy individual companies that outperform the S&P or buy the NASDAQ, then you're looking at doubling this. Now, when I go on social media, I see some people saying that we are already at the top of the AI bubble. Really? Well, let's take a look at some numbers and let's judge. Well, let me ask you to judge for yourself. So if you go back to the dot-com bubble, which at that time I was in my early 20s, so I still remember it pretty well. This was the NASDAQ 100 during the dot-com bubble, which peaked in March of 2000. At that peak, the PE ratio, which is the price to earnings ratio, was 81.7 times. So where are we right now? As of now, the PE ratio of the NASDAQ 100 is 45 times. So we are just about halfway to the valuation level of the dot-com bubble. But bear in mind that PE ratio does not take into account the growth of the earnings. Remember, when the earnings growth is high, then the market or the stock justifies a higher PE ratio. And I can tell you that from experience or from memory, the earnings growth today of companies like NVDA and Microsoft, which are 40, 50, 200% earnings growth, it justifies the PE ratio today. And compared to back then, when many of the companies were either not profitable, and even the profitable companies like Cisco at the time, their earnings were growing at much less than today's AI-related companies. So there's no comparison. So to me, we are nowhere near that kind of bubble top. If we take a look at NVIDIA as an example, because a lot of people have compared NVIDIA to Cisco, because Cisco at that time was the most hyped up company, right? Cisco went all the way up and then it burst, and it took many, many years to get back to the top. In fact, I don't think it's even reached back to the top even now, okay? And so if you look at Cisco, you can see that Cisco, it started its run right there back in 1998. So it made a high over here. You can see it made a high, and then it broke above the high here in 1998. So this was so-called the start of the internet revolution, where people are like, oh my God, there's this thing called the internet. It will change our lives, right? So that was then, and Cisco went up 370% from the start of that breakout of the previous high, and it peaked at a PE ratio of 200 times earnings. So some people are comparing and say, oh, NVIDIA is very close. Well, really? Well, let's take a look at NVIDIA right here. So NVIDIA today, it made a high in 2021. So this was before ChatGPT was released, before people even thought about AI, right? And then AI, ChatGPT was released somewhere there, and then the whole revolution started, okay? And then NVIDIA broke above the 2021 high right here. So I'm kind of like comparing it to Cisco. So since then, NVIDIA is up 124% from that breakout. So if you compare to Cisco, Cisco went up 370%, NVIDIA is only up 124%, right? And while Cisco peaked at 200 times earnings, right now NVIDIA's PE ratio is 65 times earnings. Now this is based on the last 12 months of earnings, but you know that NVIDIA's earnings are growing at 200%, right? So if you take next 12 months forward earnings, forward PE, then NVIDIA's PE ratio is now only 27 times earnings. So actually NVIDIA is nowhere near where Cisco was in terms of how expensive it was back then. Now, before you get all FOMO and say, oh, I'm gonna buy NVIDIA right now before it starts running higher, wait, cool down, relax. I keep telling my students that investing is a marathon, it's not a sprint. So like I said, we're in this new technological revolution, we're just at the beginning. So, think of it as a marathon, 42 kilometers. We are only at the 5 or 6 kilometer mark. So there's a lot more to go. There's a long runway, and I wouldn't jump in right now to NVIDIA. Now, I still own NVIDIA shares. Now, some of you may say, but didn't you sell your NVIDIA shares? Yeah, I did. I bought it back at about 400, okay? I sold it at about 390 something, and I bought it back at 400, okay? So I'm writing it up as well. So right now, I own NVIDIA, and I'm not buying more right now, even though I think that it can still run way above $1,000 by the end of the year, but I'm not jumping in right now because remember the wave pattern, right? Wave up, wave down, wave up, wave down, wave up. I never like to buy after wave up because after wave up, there will always be a wave down. So I'm patiently waiting for the next wave down, next retracement. So I just did a quick revaluation of the intrinsic value based on their latest free cash flow and latest growth projections. So right now for NVIDIA, my valuation is about $679. I think, did I say $690 earlier on? My bet is $7.79. So based on the current share price of $7.85, and I think today is going to go up a bit more, then it is overvalued. It is slightly overvalued, so I'm not selling, obviously, because the valuation will keep growing, but neither am I buying right now. So I'm just going to wait and hold, and I'll see if it retraces down, I'll add, right? So that's NVIDIA for you. But there are some high quality tech companies that I think are still not too expensive. Like I mentioned, Google, right? So Google has been very unloved, and right now the intrinsic value that I calculated is 172. So right now at 144, it's still very, very cheap. And it's because Google had some recent PR disasters, and they have not had much love from the market, and so it remains pretty undervalued right now, Google, right? And I think that is one of those that are still interesting. Palo Alto Networks, as well as Fortinet, they are in the cybersecurity game, which is going to be a huge player in the whole AI tech revolution. It had a big gap down yesterday, 2 days ago, right? And it dropped right at the intrinsic value. So for those of you who are my students, who are subscribed to my UIP service, you got my alert. Yep, I started buying that day when it dropped down. I built a position, started with a position, and I also sold some cash secured puts on Palo Alto as well. By the way, I also sold puts on NVIDIA just before the earnings was released. So NVIDIA went up and my puts are worthless, which is great. I got free money in one day. So I'm waiting for NVIDIA to drop back down again, buy more, sell more puts, and I'll just keep doing that as we go along. What else? Well, if you look at Amazon, for example, which I think is going to be one of the biggest players in this whole game, Amazon is still undervalued. I mentioned this before. It's $182 intrinsic value, and right now it's still cheap, right? But again, would I add right here? No, because I always like to wait for a bit of a retracement to at least the 50 moving average. Okay, so do your homework, look around. There are still some good quality buys right now, but again, don't ever have this FOMO, the fear of missing out, and you jump in. No, just relax, because like I said, it's only the first 2 months of the year, and I do expect we should have a pullback or correction. It's just that no one knows when it's going to happen. It will happen when we least expect it. But we should have a correction of between 5 to 10%, which means individual stocks may drop 10 to 20%. Like you saw how fast Palo Alto dropped 25% in one day. It can happen, all right? So when it happens, that's when you want to take advantage and grab shares, okay? And don't chase it. You don't have to chase it. The market will always be there. We are in this marathon. We're only in the very, very early stages. So hope you enjoyed this video, and stay tuned for the next video. And subscribe if you have not already. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.